Never ask your real estate agent or wholesaler to simply send you a good deal. Guys, it makes you sound like a newbie. If you say things like, if a good deal crosses your desk, can you send it my way? If you see a good deal, just let me know. Hey, yeah, I'm really just looking for a good deal in your market. Guys, that makes you sound like a complete noob, and I know you're not an experienced investor. I know that you haven't subscribed to this channel because investors who are educated, who know what they're doing, they define their buy box, which means they define what a good deal is for their agent, for their wholesaler, to make sure they're getting the best deals for their portfolio. And today I'm gonna help you define a good deal for your portfolio, for your investment strategy. Guys, we're gonna start off, we're gonna define all of the metrics that we use that make up a good deal, that we use to measure a good deal. Then we're gonna compare real estate to other asset classes. By comparison, we can define what a good deal looks like. And lastly, we are gonna introduce a factor of risk. That's right, because as investors, we look at risk-adjusted returns. The big key word there is risk. It's not spoken about enough. It's not emphasized enough. So today we are going to introduce risk to help you define what's a good deal for you here in Bryan-College Station. Guys, stay tuned. This is gonna be a good one. You will make money off of real estate a number of different ways, and it's important that we define how you will earn your returns on this investment so that we can then compare it to other investments and determine what is a good deal. So there's three basic ways you make money off of a real estate investment. One, you grow the equity. That's probably the strongest way that you earn money or earn a return off of an investment. Two, you get cash flow. And three, you have tax advantages. Let's start off with equity. Equity is defined as the amount of value that you have in that property. So if you own a house outright, then the amount of equity you have is the market value of that house. If you have debt on that house, your equity is now the difference from the market value to the debt. That is the equity you have. And if you have a partner in that deal, then you take the difference between the market value and the current remaining principal on that debt, and you divide it by the number of partners. So for example, if you have a house worth $400,000 and your current loan balance is an even $300,000, then the partnership has $100,000 worth of equity. Let's assume that you have two partners, it's you and another person in that deal, 50-50 ownership, then your equity is $50,000. You have $50,000 worth of equity in that deal. That's awesome. So now let's talk about how you grow your equity in a deal. You see, equity grows a number of different ways. The most common are you pay down the loan, you pay down the principal on that property. So if that debt is instead of $300,000, if it's only $200,000, of course your equity grows, and we pay down debt over time. The next one is appreciation. This is simple market appreciation. Here in Bryan-College Station, we see about 4.5 to 5% appreciation on average for the last 30 years. So we're gonna see some strong appreciation. And what that looks like is that $400,000 house appreciates by 5%. That means it increases in value by $20,000. And now you have $20,000 of increased equity. The last one that people don't always think about, and that's gonna be forced appreciation. This is usually done through rehabs. So if you put in new countertops, new flooring, new fixtures, new appliances, you repaint the place, or you upgrade the bathroom, guys, that's gonna increase the value. This is how flippers make a living. So that forced appreciation, of course, increases the value and therefore increases the equity. So pay down the loan, allow the market to appreciate, or force the appreciation through renovations. That's how you're growing your equity. Up next, let's talk about cash flow. So cash flow is the difference between the money coming in and the money going out. Now, when you're running your analysis on this, a lot of people forget some of the factors involved. So money coming in, for the most part, is just your rental income. You might be making some money off of pet rent. You may make some extra money off of late fees, things like that. But for basic terms, we would just look at the rental income with the vacancy factor applied. Here in Bryan-College Station, if you're good at running your properties, I usually recommend a 5% vacancy rate, but you could push that up to 10 if you want to be more conservative. Next, we have the expense side. Now, you're probably already thinking about the expenses like the debt, so the principal and interest payments. You have your property taxes and your insurance. This is PITI, also known as your monthly mortgage payment if you're paying into escrow. So that is what most people think of as their expenses, but don't overlook the other expenses that could be involved. Maintenance is a big one. Usually 5 to 10% of the rental income goes right out the door to maintenance. And then you have your property management expense. Even if you're self-managing, there is some expense associated with that process. You have capital expenses. Capital expenses simply mean those big repairs that you won't do every year, but may occur every other year or every third year. Think about roofs, water heaters, and ACs. And then lastly, we have our other category. You could be responsible for lawn care as the landlord. You could be responsible for the water or the internet or other utilities. Those extra expenses would kind of go in that other category. So we, of course, add up all our income, subtract all our expenses, and we get left with cash flow. And then lastly, I mentioned we would talk about some of the tax savings. The biggest one that most folks are going to be involved with is the simple depreciation of the property. So if you have a residential property, Uncle Sam allows you to apply an additional expense, a paper loss. So they use 27 and a half years as the depreciation life of a property. What does this mean? Very simply, the building, not the land value, can be divided by 27 and a half years, and you get that amount of depreciation every year to offset the income that you're making. So basically, if you do this right, you should not have to pay much or any in the way of taxes on the cash flow of that property. And that's a huge advantage because now we are getting tax-free cash flow. All right, so we defined a few things, but now let's talk about some of the more sophisticated terms like return on investment, or cash on cash return, or annualized return. What do all these things mean? Well, most people want to look at a cash on cash return number. So we take that cash flow. Let's assume that you made $100 per month cash flow, income minus the expenses. Well, we would multiply that by 12, which would give us $1,200 a year in annual cash flow. And then we would divide that number by the total amount of money we put into the deal, the amount of capital we put in. That includes down payment, closing costs, and any rehab you had to do. So if you put $120,000 into the deal and you're getting $1,200 in cash flow, you have a 1% cash on cash return year one. And of course, that cash flow number can change per year. So if you're doing a more sophisticated model, you could have a different cash on cash return number as you progress into the years of owning that property. The next one we want to look at is going to be our overall ROI, our return on investment. For this, we want to include the other ways we're going to make money. The tax savings usually isn't included in here because it's a pretty sophisticated number. You're going to want to talk to a CPA to see what that actually looks like. So for the simple math, we're going to look at cash flow and the equity growth. Let's assume it's a $400,000 property and you owe $300,000 on it. You have no partners. We'll keep it simple. Year one, you have $100,000 worth of equity. And in that first year, you're going to see 5% appreciation. So you're going to see a $20,000 growth in that property. And let's assume that you pay off that loan by, say, an additional $4,000. So now you have $24,000 worth of growth on that property. Well, you put 120 into it, so you're looking at a 20% equity growth on that property. Oh yeah, plus the cash flow, so a 21% return year one. Your annual return that year is 21%. All right, so we defined some terms. We can now reasonably compare real estate to other asset classes, and that's what we're about to do. I want to break down the comparison between real estate and index funds, specifically the S&P 500, between real estate and bonds, and then real estate and things like stock trading or crypto. So let's start off with the S&P 500. If you're not familiar, the S&P 500 is an index fund, which is basically just a collection of companies that you're buying all at once. S&P 500, of course, being the largest 500 companies in the United States. So when you buy into an index fund, it's pretty damn simple. You click and you buy. It's a very passive process. The S&P 500 is more volatile than real estate prices. Real estate prices go up by 5-ish% per year, and sometimes they have dips as much as 1 or 2%. On very rare occasions do we see more than a 5% dip year over year in real estate prices. So real estate is way less volatile than an index fund, case in point, S&P 500. What about the growth? What about the average return over a long period of time? Well, thanks to great sites like Investopedia, I was able to find the average return of the S&P 500 since 1957, and it's been 10.13%. Now that's before inflation. When you adjust for inflation, that comes down to 6.37%. And that's important because real estate is a good hedge against inflation. So we're seeing a lot of that recently. Might be worth looking at real estate. But if we're looking at comparisons, you would want your real estate ideally to outperform the index fund, so you would want to see over a 10% return. The next piece I want to talk about with index funds are the dividends you get, because as you are probably aware, the index fund can increase in value, but they also can spit out annual dividends. Now, the average annual dividend since 1992 for the S&P 500 has been 2.91%. I think dividends are best compared to your cash on cash return. So if you're getting a 2.91% payout on your dividends and you can get over a 3% cash on cash return and you're getting over a 10% return on that piece of real estate, so 10% overall ROI and better than 3% cash on cash return, you are probably beating the S&P 500. All right, that's one point of comparison. Up next, let's talk about bonds. Bonds are known to be way less volatile than things like stocks. Bonds basically are where either governments, so you have US treasuries, which are bonds, or corporate bonds, or local municipalities, they're issuing debt. You, as the bondholder, hold debt from that institution, from that government entity, and they are paying you on a regular basis based on the value of that bond when you bought it. In general, again, I'm looking at Investopedia because quite honestly, guys, I don't invest in any of this stuff. I only invest in real estate, but I do look at it for points of comparison. So according to this, the overall bond market over the last 30 years has spit out 6.1%. That's a 6.1% return. There are no dividends. That's just your return on that bond. So in general, if you can find real estate that spits out 6.1%, you are beating bonds. All right, so next, let's talk about crypto and individual stock. I throw this into the extremely speculative side of investing. Yes, you can see ridiculous returns in crypto, like 50% this year or something bonkers. I'm not even gonna look it up. I know that it's crazy, and I know there's folks out there that are gonna tell you about how much money they made in crypto, or how they bought into this penny stock, or how much they made off of GameStop when they went bonkers. Got it, great. What I'm telling you here is there's the similar side to real estate. You can buy extremely speculative real estate. There are people flipping land for all kinds of money. You can buy land and flip it to a developer and make ridiculously outsized returns. But in my opinion, that is extremely speculative. Speculative means that you are gambling on the future. Speculative means high risk. Risk is the next thing that we're going to talk about, because ultimately I want you to have the best risk adjusted return. And because this is focused on our newer investors, guys, we're going to look on the lower risk side of things, because I do not want you to risk your hard-earned money on your first investment. Guys, let's talk about risk. Your analysis of risk is critical to your investments. Guys, they don't talk about this enough, because everybody wants to flash you the high returns that they're getting in these speculative investments. But ultimately, risk is as important, if not more important, than your ROI. Guys, listen to Uncle Buffett, not Jimmy, RIP, but Uncle Warren Buffett. He's going to tell you that rule number one in investing is don't lose your money. What he really means is invest in low risk opportunities, or at least mitigate your risk to where the return is worth it. So let's first look at those other asset classes we just talked about and the risk associated with them. Starting off with bonds. These are considered to be the least risky. Specifically, U.S. Treasury bonds. Guys, these pay out every single year and are known as the lowest risk investment you can make, but ultimately they're also low reward, low return on investment. Up next would be your index fund, your S&P 500 index fund. Guys, it's considered low risk because on a long enough time horizon, it has always gone up, but that doesn't mean it doesn't have down years. So yes, if you hold it long enough, you will make money, but if you have to sell in a down market, you could lose money, hence the risk. Next, we have individual stocks. So yes, if you invest in things like Tesla or Apple or Facebook, you would have made a lot of money. But if you invested in things like Sears or Macy's or Blockbuster, you lost a lot of money. So there are booms and busts. There are companies that are growing and dying. Trying to predict that is very hard to do, hence risk. And then lastly, are purely speculative. I can consider this the equivalent of gambling, and that would be, for me, crypto. Guys, you can argue with me about this in the comments, but I think that crypto is a gamble and therefore should not be considered in a risk-adjusted return. I don't consider going to Vegas an investment strategy. My personal opinion. Let me know what your opinion is. So how does all of this apply to real estate, or how does it relate to real estate? Well, in my opinion, I believe that buy and hold investing in real estate is some of the lowest risk and best risk-adjusted return you can get. I think it is slightly safer than investing in index funds. Again, argue with me in the comments all day, but that is my personal opinion from the research that I have done. So we're somewhere in the risk category of index funds, which is great for things like retirement accounts or long-term investment strategies. But it is not without risk. Okay, so how do we mitigate that risk? The first major risk category that you want to look at and analyze is going to be your debt. The more debt you have, the more risky your investment. So if we buy something with cash, we have very little risk. Buying with cash is the equivalent of buying a bond, in my opinion, because real estate prices have appreciated year over year over time. Therefore, you're likely to get your payout. You have very little expenses because you don't have principal and interest payments. Buying with cash is a very safe, low-risk investment. Of course, the more debt you introduce, the more risky it gets. If you want to know more about that, just go check out Mr. Dave Ramsey and hear what he has to say about introducing debt into your deals. The amount of debt is important, but also the type of debt you get. You see, not all debt is created equal. Not only are there things like amortizations and interest rates that affect the debt, which ultimately will affect your ROI, but also who you get the debt from. If you get a 30-year fixed interest rate from a bank, then it is a pretty secure debt. But if you go to a hard money lender or a private lender and you get debt at 10% that's going to mature in 18 months, that is risky. Will that property be worth more in 18 months? Will you be able to refinance your money out? To be determined. So not all debt is created the same. So the type of debt and the amount of debt both affect risk. I recommend that as a newbie investor, you look at buying real estate with 20% down and getting that debt from a bank, a 30-year amortized fixed rate loan on that property. So the other ways that you can introduce risk or mitigate risk is based on location. In general, here in real estate, we classify areas by A, B, C, or D. That is how we determine the quality of a neighborhood or investment area. You can also think of it as the least to most risky neighborhood. A would be your gated community where houses sell for $500K plus, at least in my market. The B community would be a little bit older. Maybe their houses are 10 years older. It's not gated, but it has an HOA, and generally it's in pretty good condition or newer-ish. You've got granite countertops, but they're a little old. C would be like your 1960s, 1980s built homes, older neighborhoods. Some of the neighbors are a little sketch, but for the most part, a decent enough neighborhood. And D's are considered our war zones. Guys, the way that I mitigate risk when it comes to neighborhoods is a simple question. Would I send my wife to the property at night for a maintenance request. If the answer is no, we don't invest there. That's how I mitigate that risk. I recommend you come up with a similar criteria for yourself. But of course, if we buy in that gated luxury community where we buy the house for $500K, it might only rent out for $3,000 a month. We're not going to get a great return. So again, the return, risk-adjusted return gets worse the higher up we get, but it's also very risky on the lower end. We want to be somewhere in the middle. I recommend B or C class neighborhoods. The property is also a way that you can mitigate or introduce risk. So the age of the property matters a lot, guys. Buying a brand new house with a builder warranty has very low risk. For that first year, you're not worried about anything. Buying a 1940s built house that's pier and beam with a slow leak under it is very risky. Ask me how I know. We just put $40,000 to fix the subfloor on my house. It's a 1940s built pier and beam with a slow leak under it. So that was inherently a more risky purchase than had I purchased a brand new house. So if you want to reduce risk, go for a newer build. Guys, what we're trying to say here is that if you have the same ROI on a 2015 built house compared to a 1940s built house, I'd go for the newer asset. Next thing that introduce risks are the tenant themselves, and really that's going to be whether you're inheriting the tenants or whether you are listing the property for lease and you're screening the tenants. Of course, the more strict your screening criteria are, the safer your investment will be. We don't want to put in some rando off the internet into our investment property. We want to put somebody who's well screened. We know they make the income. We know they have the credit. And we know they're going to treat our property appropriately. In general, for my newer investors, take on as little risk as possible while hitting the returns that you're looking for, which brings us to our bonus content, our client question. And I get this one, and usually after a conversation like this, my clients are asking, Greg, what about your investment criteria? What do you look for in your investment criteria? And guys, I keep it pretty simple. Like I said, I think that buy and hold investing is very comparable to the S&P 500. And I just told you the S&P 500 gets a little over 10% on a yearly average basis in terms of its growth, and it spits out about 3% in dividends. So for me, what that means is I want double-digit ROI and I want positive cash flow. Guys, if I get those metrics with my conservative numbers, 9 times out of 10, I will beat them in reality and therefore beat the standards of the S&P 500. I'm also going to mitigate the risk during that process as much as possible. I don't do gut jobs. I minimize my rehab. I try to buy houses that are relatively newer, 1980s or newer, and I buy in neighborhoods where I would send my wife and my daughter at night without worrying. Guys, that's how you get the best ROI and adjust for risk. Hopefully that helps you define your buy box. Let me know in the comments below what your buying criteria are and whether I'm too conservative in my investment strategies. Guys, as you know, I'll have a new video next week. Please like and subscribe if you haven't done so already. And otherwise, until next time, you take it easy.